So on the secondary market liquidity platforms that I watch as a trader and portfolio manager for our, US dollar investment grade fixed income funds and accounts, I've just, in my noticing the last quarter or so, I've seen the pickup again in liquidity requests for Federal Home Loan Banks or FHLB bond offerings, right? So I see that and I'm thinking to myself, huh, what's going on? And I want to just, peel back the layers of the onion and then put it in context of our framework, right? And if it foots, it makes sense. If it doesn't, well, time to update your framework. All right. So starting with that realization or that just observation, hey, I'm seeing a lot of these on my screen. What's going on? Start like let's dive in and try to get a sense of how this plays into all of the big picture, right? So headline here, this is an article dated March 26th from this year on Bloomberg, but this is like this is like the first inclination of something developing. And you know how financial markets work. The news that eventually comes to the front page headline, like shows up on everybody's radar, it's actually on page A32 or something before the fact. It's the story develops and works its way forward. Is kind of how these work if you think about them as financial markets developments. So right now we're still on like we're back on page A32. You can hear people talking about the intersection of what's going on here. And this story is about private credit, insurance companies, and the kind of the cross border sovereign debt and foreign exchange carry trades, like the Japanese yen carry trade or the offshore dollar carry trade, all of that. But in my mind, all of those things, that nexus, this is what's coming to its head and working its way into the front page. So the same way that SpaceX and the AI builders are kind of rushing to stockpile dollars while the liquidity is available. Like you get your chair in the game of musical chairs while the chairs are there is kind
Right.
of how you play. We're seeing that same thing going on in the FHLB system. And just a reminder to jog everybody's memory for everyone who was paying attention back during the regional banking kind of mini crisis that developed in the first half of 2023. The FHLB operates as kind of a lender of second to last resort, right? So the Fed is the lender of last resort. It's your last stop, right, for emergency liquidity when the music turns off and everybody's scrambling for musical chairs. Think about the FHLB as like a line of defense sitting right in front of that, and the FHLB system has a broader customer base than just like the Federal Reserve, which will only um, or like primarily serves its member banks, right, for that
Right.
emergency liquidity, right? So it's the heart of the system. Um, FHLB, you can be a bank, you can be a credit union, an insurance company, a non-bank lender, or like other types of financial institution that you can do business with these banks. You just have to broadly work towards this mandate that Congress has established for the FHLB system banks that like you need to provide capital into the US, mortgage lending industry to make home buying, affordable, access, all of that for US households, right? Um, but you can think of these how they're actually used. It's kind of like a fast cash ATM pawn shop type of window. So any one of these customers can show up with like a specified list of acceptable collateral, and that would include a US Treasury bond or an agency bond from an issuer like Fannie Mae, Freddie Mac, et cetera, or a mortgage-backed security, like it's got to be related to the mortgage industry, right? And that
Right.
mortgage capital mandate, and you post that as collateral in return for a cash advance, right? And what you're doing is you're getting dollar access at an affordable rate, right? You're getting liquidity is what you're doing.
Right.
All right. So we just got the data for first quarter 2026 on these fast cash advances. And what stood out is a record level of advances going to life insurance companies, which broke the prior record that was set in first quarter of 2020. Right? Remember when we talked about we're trying to anchor our mindset. We talked about first quarter 20 or yeah Q1 Q2 2020. That was the previous like all time high issuance as well for the investment grade new issuance market for the record month, June 2026 as well. So we're seeing similar records being set across all of these different kind of milestones or signposts that we'd be looking at to get a sense of where we are in the cycle. So this data is published about a quarter after the actual activity and the results get aggregated. So this is a lagging indicator of what's going on, but it shows the trend and the direction of travel, like where the trend is moving, and like points to the underlying driver behind the activity we're seeing in yield curves, credit markets, and foreign exchange. So if you go here, this is more of a real time issuance. And so what I did is this is where someone like me, who is the bond buyer, right? I'm looking at secondary markets, and I'm an investor. My accounts represent sources of capital that would buy the FHLB's new debt issuance. And what they do for those fast cash advances, right? Your borrower will show up, they'll pledge their acceptable collateral, and they'll get that fast cash. That fast cash has to come from somewhere. So the FHLB banks, what they'll do is they'll issue debt to raise those dollars, and then they'll kick in some equity as well from their own balance sheet, and then that funds the cash advance.
I
So you
see.
see this in the chart. Like, look at this, um, like these issuance levels, and this is just total bonds issued by quarter, going back for say 10 years, and you can see what's happening here. It's obvious the growth, but
Yeah.
I separated these out into coupon type because one of the other things we talk about is SOFR adoption, right? That transition from LIBOR to SOFR and how important it is. So number one, you see like the amount of debt being raised. That's your proxy. That's your leading indicator for that need for liquidity from the FHLB borrowers themselves, like their end clients. So you see that the Q2 number for new bond issuance, we have like 5 more days in the month, so that number can go up. You can see in Q2, while we did set a record, it didn't blow out that same jump we saw in Q1, right? We had a major geopolitical development with Epic Fury, Iran, and also overlooked at this point, Venezuela on Gen 1. So
Yeah.
geopolitical disruption, all of that, that makes sense for the spike up. Q2, we're still set a record, but it's taking a breather. But what we're indicating, like we're continuing to set nominal highs. This is incremental, right? So like what was issued in Q1, we add that on top, like Q2 on top of that. Then the other thing I want to call out, the orange line, that's floating rate debt raised by the FHLB, which is SOFR indexed. If you go back and look at all, like just sum all of those orange lines over time, the SOFR linked issuance. So FHLB has issued, I want to say it's like $3.2 trillion of SOFR indexed floating rate debt. It's really plugged into that organization or that new adoption around SOFR, which is like secured treasury repo, all of that. That is pulling away the offshore dollar activity, the liability-based dollar. It's that sucking in of the marginal dollar in the global system from, the offshore money system, fractional reserve, all of that towards, secured lending, hard money, something more like hard money lending for dollar credit creation that really originates in New York as kind of the epicenter. So
I
huge
see.
things going on, and that's pointing to um, this lender of second to last resort becoming increasingly important. So if you look at the customer composition of these FHLB advances over time, you can see that insurance companies are becoming an increasingly important part of their book of business. So their largest customer is going to be U.S. commercial banks. It's like roughly half of their book of business, but you can see that black line. There's that huge spike in 2020 and 2021, but you can see the trend. It's up and to the right. If at this point, something like mid 20s, 26%, I think, as of the last time they reported on this, and the data was December 2025, so they were 26%. You've seen the new issuance we talked about in Q1 and Q2 of 2026. I would expect that number is going up and to the right on the insurance companies. And what's going on, if you're looking under the hood, This is reflecting the insurance industry's exposure to private credit, right, which is non-bank, non-public debt markets, dollar lending that was allowed to develop and really, grew like mushrooms in the post-GFC, ZERP, QE, fiscal insanity era. That was really the core enabler behind this trend. So poster child, the case in point, Apollo's insurance company, Athene, has become the FHLB's second largest borrower in the system. And that was according to that same kind of report of the against the customer composition from December 2025 we talked about. But you can see as of 2025 that FHLB's total advances outstanding to Athene have grown past $20 billion. So it's I'd say it's risen to one of their top customers. We don't have any data yet for 2026, but given that the surge we saw in Q1, Q2, I mean, it's coming from multiple players, but yeah, you'd expect Apollo or Athene, the related party, to be part of that. So, what was happening here? You had a proliferation of non-bank, non-public markets, dollar lending, this whole private credit trend. Um, Increasingly, you're seeing the middle market companies that those private equity and private credit shops deploy the direct lending mostly into are having trouble maintaining or making scheduled interest payments. They're increasingly relying on PIK or payment in
Picks.
kind,
Yeah.
which is really just saying like you don't have the actual cash, but you're paying people an IOU, right? It's the
Yeah.
Jim Carrey from Dumb and Dumber. Like, don't throw those away. Those are as good as money. um, so yeah, that's the big picture of what's going on. So that stress. So if you think about it, these insurance companies, they're tied up. So if you're like let's say you're a Theme, like what you've done, you go to mom and pop, they show up with their nest egg. Let's say they saved up $1 million over their lifetime and, oh, we're going to retire. We need a future income stream, right? So what do? You go to your financial advisor. He goes through his book and he says, oh, I'll go through and get you a fixed rate annuity or some sort of product like that. And this will give you your income stream in retirement. And that's in addition to your social security payments. Like your counterparty would be this annuity issuer, right? What does the annuity issuer do once mom and pop hand over their nest egg, their dollars, right, to the financial advisor, to the annuity issuer? Well, then the parent company, let's say it's Apollo here, they go and originate a private credit loan. They deploy into that. They earn a yield spread. Let's say it's whatever, SOFR plus 700 or something. Your annuity payment is locked in, and then there's a spread there, and then Apollo's business model is we pocket that. So, it's a big go look at their financial statements. And everything works, right? You're kind of a middleman, a counterparty, a pass through. But if your borrowers are having trouble making business because, business changes or we didn't do good credit underwriting, what have you,
Rates go up.
if rates go up, if your dollars aren't coming in the door, you still got to pay dollars out. You've got a problem and you need to go tap liquidity like while the music is still playing. That's what these FHLB advancers are. So that's what's going on behind the scenes. So remember back the urban legends that have built up the stories, the iconification of these investors like Michael Burry. I forget that whoever Steve Carell was playing in The Big Short, all of that. Um, that same thing you're starting to see happen here around this whole private credit insurance company project, and then it's also there's a cross-border element to it as well, like Japanese life insurers were, like, deploying into this same liquidity pool. So there's a Japanese carry trade element to this, which impacts the sovereign JGBs, the Bank of Japan, everything going on with the yen. It's all packaged and caught up in this complex. But you're starting to see those same like Michael Burry type of stories where you've got a hedge fund manager who was on the same side of shorting the subprime into 2008. There's just one story. Lee Robinson's hedge fund in based in London is buying CDS on U.S. insurers who were overly exposed to this private credit trend. It's still small, like, there's 5.5 billion outstanding in CDS here. That's a relatively tiny amount, and then this whole private credit, sleeve of all of the total dollars of credit outstanding, like, it's 2 to $3 trillion. So it's like maybe like 1%, low single digits percent of all of the entirety of the dollar credit bubble.
So the scale isn't as big as what other people are kind of comparing it to, right? Like in
Yeah.
like oh wait, all of that. Yeah.
So if you're concentrated and you're a part of this pocket, like it will hurt. Like definitely there's going to be L's taken. So if you're tied up in this thing, you could be overly exposed. But going back to 2008, like subprime, in terms of where the credit stack was back at that point, like it wasn't, I don't know the exact amount where it was. It wasn't hundreds of trillions. Like it might have been a third the size or something like that of what it is in 2026 and what we mushroomed this thing into after Bernanke, Yellen, Powell, plus an American Congress who will pass any fiscal bill to go along with the QE and ZERP. It's we're looking at a bigger denominator, and then the numerator, even if it's roughly the same size as subprime, which it's not, it's going to be like private credit is a fraction of total subprime lending. Um, it's not going to be the same in my forecast. Like it may be proven otherwise, but 2008 and 2020, those probably aren't your like scale of comps here we're talking about. But if you're in this niche, like it'll feel like that,
Right.
if that makes sense, right? All right. So last story here. So we're working towards this, and this is the FHLB advances. All of that. We're moving towards something, and it has to resolve itself at this point. It's like that's where we're going. And the biggest story this week, if you're looking for blood in the streets, it's been in these perpetual preferred offerings from the Bitcoin treasury companies. The most famous or notable of those is Strategy or MicroStrategy, as many of us know it from the old house name. Point here I want to make, um, for everyone on like social media or watching this podcast, if you're focused on Bitcoin, like for the long term, and it's a dot now that we're nearing 2 decades in since Bitcoin's arrival in 2008, if you're thinking about this from like a Bitcoin centric process, which we try to do, but we try to not make it like so down your throat, like jam it down your throat type of thing. This process where the world is going through an organization around this ledger in cyclical fits and starts and the booms and busts. I want you to like squint your eyes at this chart, and this will help you see the forest for the trees. I think it's actually like if you look more fuzzy, you can see the clarity here. I've got strategy here in the orange line, and then I've got the private credit and private equity major houses here: Blackstone, KKR, and Apollo equity prices. And what I'm trying to get a sense of here is look at the correlation, not in the sense of the daily moves, but zoom out over the cycle. And what you see here is they're following the same moves of like non-bank dollar credit, and the rising and falling of the waves and the tides in this cross-border kind of capital system, right? And the big picture war that we frame this as going on. So, um, like what you're seeing here, if you think about post 2008 GFC, legislation and regulation like Dodd-Frank pulled away this entire business of corporate lending, basically middle market. If you can't qualify for public debt markets or even for high yield offerings, you've been kind of left out and you have nowhere to raise capital except for, you'll have to turn to direct lending like these private equity issuers or private
So
equity,
like
private credit.
Blackstone or something like that.
Yeah, exactly. So if you think about this peer group, right, how they differentiate between each other, you can change your capital structure on the right-hand side of your accounting T table, the balance sheet, and you can, change your composition of debt and equity, all that. And then on the asset side, you can change your composition of equity, credit, quality, or in strategy's case, you're going to go even more beta to the cross-border capital markets, which is dollar denominated, right? You go even more beta, lever up, and just go full Bitcoin, right? So if you think about what's going on, this whole offshore dollar, the global capital markets, they're all swimming in the same pond, right? And what we're seeing with strategy this week and my framing, that's your that's your outpost, your frontier credit, like new, risky, most speculative type of thing um, within this universe. And then on the asset side, all right, same way that Bitcoin has been in a market drawdown since Q3 of 2025, that same liquidity pressure, it's been building through the cycles, and it's now materializing into the equity and credit exposures on the balance sheets of these other kind of related non-bank financial firms, right? So, yeah, so what we're seeing in combo of like MicroStrategy and the Bitcoin treasury companies, in my framing and understanding of the big picture, that's just one more indication of like the bleeding edge of this big picture trend and where we're working towards in this dollar cycle. Same thing with the FHLB advances, same thing with SpaceX, and then your other AI build out firms, your hyperscalers, they're going to increasingly tap the US dollar investment grade credit markets. That's your tell that all of these players and the people who know, and they are the ones, their activity sets the market, right? We're all preparing for something bigger that's coming down the pike.